Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings so you don't have to. Today, we're cracking open Teleflex Incorporated's latest report. Are they making the right moves, or are they just rearranging the deck chairs on the Titanic? Let's find out. Teleflex, a company that makes medical devices, filed a report on February 28, 2025. This report is called an 8K, which is something companies use to tell investors about big events happening. In this case, Teleflex is telling us about a plan to buy back its own stock. So who is Teleflex? Well, they're in the business of making medical devices. Think of things like catheters, surgical tools, and other equipment that doctors and hospitals use. They're a pretty big player in this field, competing with companies like Medtronic and Johnson & Johnson. Now let's get to the heart of the matter, the stock buyback. Teleflex is planning to repurchase shares of its own stock for a total of $300 million. They're doing this through something called an Accelerated Share Repurchase Program, or ASR. Basically, they're hiring a bank, JP Chase, to help them buy back a large chunk of their stock quickly. Why would a company buy back its own stock? There are a few reasons. One is that it can boost the company's stock price. When there are fewer shares available, each share becomes more valuable. It can also be a way of returning cash to shareholders, kind of like a dividend. Some view it as a sign that the company thinks its stock is undervalued and a good investment. Here's how the ASR works in this case. On March 3, 2025, Teleflex paid JP Chase the $300 million. In return, they got an initial delivery of company stock worth 80% of that amount, based on the stock price at the end of February. The final number of shares Teleflex repurchases will depend on how the stock price moves over time. If the stock price goes up, they'll get fewer shares. If it goes down, they'll get more. It's like a bit of a gamble. There's also a chance that when it's all said and done, Teleflex might have to give JP Chase more shares or cash, depending on how things play out. The whole thing is expected to wrap up sometime in the second quarter of 2025, but JP Chase can pull the plug earlier if they want. To pay for this buyback, Teleflex is borrowing money using its existing credit line. This is interesting because it means they're taking on debt to buy back their own shares. It's a bit like using a credit card to invest in the stock market. It can work out well if the stock price goes up, but it can also be risky if it doesn't. Now, this buyback is part of a larger $500 million share repurchase program that Teleflex had already announced. So they're using this ASR to speed things up. But is it a smart move? Well, it depends. Let's shift gears and talk financials, even though they're not explicitly detailed in this specific report, but context is important. Teleflex's recent quarterly and annual reports would typically give us insights into revenue, profit margins, and debt levels. Investors would scrutinize these numbers to assess the company's overall health and growth potential. Imagine if we saw consistent revenue growth that would suggest Teleflex is successfully selling its medical devices and expanding its market share. Strong profit margins would indicate they are managing costs effectively and generating healthy profits from those sales. However, if we saw a significant increase in debt, especially if it's used to fund share buybacks rather than investments in research and development or acquisitions, that might raise some eyebrows. It could suggest the company is prioritizing short-term stock price gains over long-term growth. Now, let's tie this back to the buyback we've been discussing. A share repurchase can make sense if a company has excess cash and believes its stock is undervalued. But when a company borrows money to buy back its own shares, it's essential to examine the numbers. In an ideal scenario, the positive impact of the buyback, like a higher stock price, will outweigh the cost of borrowing. It's a financial balancing act. So what's the story here? Teleflex seems to be betting on itself. They're confident that their stock is a good investment, even if it means taking on debt to buy it back. They must feel like they're in a strong financial position. They are likely anticipating that these buybacks will help increase shareholder value. However, there are a few things to consider. First, borrowing money always comes with risks. Interest rates could rise, making the debt more expensive. Second, the medical device industry is competitive, and Teleflex faces challenges from larger companies and smaller, innovative startups. Can they continue to grow and innovate in this environment? And third, healthcare regulations and reimbursement policies can change, impacting the demand for their products. We can say that in the short term, this may provide a bump in the stock price. However, it is not without risk. In conclusion, TELEFLEX is making a bold move by taking on debt to buy back its own stock. Whether this will pay off in the long run remains to be seen. They must think their long-term health is promising. We will have to watch how things play out over the next few quarters to see if this bet pays off for investors. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Let me know in the comments what company you want me to decode next.